Welcome, everyone. I'm Fred Kemp, President and CEO of the Atlantic Council. And on this incredibly busy day in Washington with the World Bank and IMF spring meetings about to kick off, and of course we did the curtain raiser for these meetings with Executive Director of the IMF, Christine Lagarde, last week. Now following her, we're enormously pleased to have the European Commission Vice President for the Euro and Social Dialogue, Valdis Dombrovskis. I can't resist just noting, having been a journalist at the Wall Street Journal covering the Soviet Union and having spent a great deal of time in Riga and Vilnius and Tallinn in a different era, what a pleasure just the fact that we have a former Latvian Prime Minister and Finance Minister serving as Vice President for the Euro and Social Dialogue, Vice President of the European Commission. So, Mr. Vice President, just on that note, it's so wonderful to see you here. And then on another note, you played a crucial moment in Latvia's history, economic history, at a very difficult time, 2009, 2010, where Latvia could have been a model for how things can go wrong in the European Union, but instead it became more of a role model for reform in the EU, where in return for substantial international aid, you made quite stringent cuts. 2009 alone, wages were reduced by 30%, government spending cut by 20%. But over that time, you showed where if a government under onslaught sticks to its guns and comes back to the market and makes itself attractive enough, you can start achieving growth rates of some of the highest in the European Union on a consistent basis. As Vice President of the European Commission, you oversee the entire process of coordinating macroeconomic and budgetary policy among the EU's 28 member states. You also guide the so-called European semester program, and that is not a semester abroad for U.S. college students in Europe. It's rather a delicate process by which draft budgets are submitted by member states to Brussels prior to parliamentary approval. Prior to taking your post as Vice President in 2014, you served as Prime Minister of Latvia from 2009 to 2014, then as Minister of Finance, as I said. We're honored, particularly because this is your first time in Washington for a public address in your new capacity. Your current portfolio is broad and deep. When European Commission President Jean-Claude Juncker laid out your mandate, he wrote, quote, "The stability of our single currency and the solidity of public finances are as important as social fairness in implementing the necessary structural reforms," unquote. So in that sense, it makes good sense that the Commission has brought together the Euro with the idea of social dialogue. The situation in the fragile states of Europe remains volatile, and without serious economic improvement, social and political stability are at risk. Christine Lagarde here talked about the dangers of the new mediocre, and also talked about the shot in the arm for Europe of oil prices, devaluation, and QE from the ECB, and how one can't miss this moment to implement structural reforms. We at the Atlantic Council are following the events in Europe closely. Today's discussion is the fourth event in the Atlantic Council's EuroGrowth Conversation Series, launched by the new director of our Global Business and Economics program, Andrea Montanino, who's come to us from the IMF and from the Italian Treasury, and we're delighted to have him here as a relatively new leader at the Atlantic Council. And this is a new ongoing conversation about the prospects for European economic recovery, which he can give a lot of actuality to, being European himself and having gone through this in his various previous jobs. It's a forum for leading policymakers, academics, and the private sector to share and discuss new and innovative ideas about how to get Europe growing again. The series takes a long-term perspective toward the region, so we're delighted to have Vice President Dombrovskis here. Alongside this EuroGrowth initiative, we've also launched a trade and security initiative. It will be actually launched next week, April 23rd, with a public speech by Secretary of State John Kerry here at the Atlantic Council, where we will also be making the connections between the trade deals that we're trying to get done, TPP and TTIP, and the Trade Promotion Authority that will need to precede that, and their connection to this Euro growth story, but also the connection to geopolitical questions and national security. For those of you today on social media, please follow along and join the conversation using the Twitter hashtag #ACGlobalEcon. We look forward to continuing the EuroGrowth Conversation Series in the coming weeks and months. And for now, please join me in welcoming Vice President Dombrovskis to the podium.
Good morning, ladies and gentlemen. First of all, I would like to thank Atlantic Council for this invitation and for the possibility to share some thoughts and considerations about how European economy is doing, and certainly I would like to thank Atlantic Council for a long-standing interest in European affairs and actually promoting US and EU cooperation. Thank you. So, as regards economic situation in Europe, so where do we stand now? Currently, we are recovering from a long and quite severe double-dip recession. But unfortunately, it must be said that this recovery is quite slow, and also job creation is quite slow. Nevertheless, growth is gradually accelerating. We are expecting to have in euro area economic growth of 1.3% this year, and it would accelerate further to 1.9% next year. And indeed, in maybe some 20 days or so, we are to issue new economic forecasts, so-called spring economic forecasts, and I would say that it's more likely that those revisions are going to go upwards as regards Europe's growth estimates rather than downwards. And this also with, I think, consistent with a recent improvement of Europe's growth prospects by the IMF and also in several other forecasts. There are several factors which are facilitating this gradual economic recovery, also several external factors which are helping right now, like decreasing oil prices, like accommodative monetary policy of European Central Bank, including quantitative easing and corresponding exchange rate developments between US dollar and euro, and also this environment of low interest rates is generally helping the economy. There are some concerns about very low inflation, but we are seeing signs that this will normalize in a due time, because also the factors which are driving this very low inflation are mainly external factors. Once again, very steep decline in oil prices, which we had been recently seeing. Financial market conditions also have improved. Also, announcement of ECB's quantitative easing program has driven down sovereign bond yields, and it's especially helpful for peripheral countries. And also, corporate bond yields are continuing to decline, and equity prices are currently increasing. So at this stage, so what is the right policy mix for Europe's economy? We believe this right policy mix is reflected in the European economic policy priorities, which we are outlined in annual growth survey, and those are boost to investment with so-called investment plan for Europe, or this well-known 315 billion investment package. Structural reforms both at EU and member states level to strengthen the competitiveness of the economy and productivity, and still its fiscally responsible policy. And I will probably go a bit deeper in those three priorities, also to outline the similarities and differences with the situation in US. First, on investment. So this is clearly a priority for the new Commission to launch this ambitious 315 billion investment package, and with a limited amount of public investment, unlock substantially larger amounts of private investment. And there one can make a comparison with the situation in US, where investment also declined sharply during the crisis, especially in 2009, but has rebounded strongly ever since. There was some last year's data, but I think it still was quite illustrative on investment into equipment, which has recovered or increased by some 33% since the crisis in US, and only by 3% in Europe. So there is a quite stark contrast, and the estimates between current levels of investment and what could be considered some long-term sustainable trend of maybe 21% of GDP, those estimates of the investment shortfall will vary somewhere between 230 and 370 billion euros. And if you look at this investment plan we are currently working on, initial amount announced was 300 billion, exactly in the middle of this range for investment shortfall. Then another important aspect about investment is also the analysis. So why investment is lagging behind in Europe? And it's not because of the lack of market liquidity. Liquidity is there, financing is available. European Central Bank is providing liquidity to the commercial banks at record low interest rates in order to lend to the real economy, but unfortunately it's happening to much lesser extent than one could have wished for. And the reason seems to be very strong risk awareness of both borrowers and lenders. And so the idea of this plan is to provide some kind of a additional reassurance for private investors, first risk absorption capacity, some other elements which would actually unlock the investment which would otherwise not happen. But for this, it's quite important that this investment is investment fund is professionally managed, and that's why we're paying so much attention to how this fund is going to be managed, with strong involvement of experts from European Investment Bank, and without, say, a country or sector quotas, so that projects are really evaluated based on their quality, based on how they match the criteria, based on their economic viability, and there is no political meddling in this decision making, so that private investors could also trust this decision making. Another important element as regards as regards investment and financing the real economy is, as already mentioned, some shortages in banking lending. So we are also looking on sources how to complement it, and once again drawing some inspiration from US. So recently European Commission announced initiative for a capital markets union, because lending to the real economy, lending to the companies in Europe is heavily dominated by banks, whereas in US there's also much more equity financing available for companies. So with Capital Markets Union we also intend to encourage equity financing of the companies, not so to say instead of the bank financing, but to complement the bank financing, to provide some additional ways of financing companies. Then on structural reforms side, and this is something what we are emphasizing a lot, and there are things which need to be done both at European and at member states level. At European level, we are talking mainly about strengthening EU internal market, dismantling the remaining barriers within the EU, especially in areas like services, where there are still shortcomings, in areas like energy, where there are clear bottlenecks, in areas like digital, where we are actually launching the initiative of creating digital single market. And at member states levels, those reforms are of course country specific, but some of the recurring themes are flexibility of the labor markets, shifting away tax burden from labor to other tax bases which are less decremental to growth, such as consumption, as property, as capital, dealing with opening up of closed professions in some member states, dealing with some problems, issues in goods and services markets. In some member states it's also efficiency of public administration, independence of judiciary. So there are different sets of problems which different member states need to address, but it's very clear that you cannot sustain high level of prosperity without high level of competitiveness. So we must really look into our competitiveness factors in Europe and to do the necessary reforms to address the shortcomings which we are identifying. Third, fiscal discipline. This is of course often being contested. There is lots of debates somewhere around the lines of austerity versus growth. So a couple of observations there. So where we stand right now, yes, we see somewhat more fiscal space in Europe, and we expect to have a broadly neutral fiscal position in euro area this year, meaning neither overall fiscal stimulus nor additional fiscal adjustment. But at the same time, average public deficit in euro area will move down from 2.6% of GDP to 2.2% of GDP this year, and this thanks to the economic growth. But also on a fiscal side, one must note that the situation is not even. There are still countries with excessive deficits, which according to EU's definitions is deficits exceeding 3% of GDP. Of course, these countries need to continue their effort to actually bring down their deficits to the sustainable level. But we believe that this situation, having a broadly neutral fiscal policy together with accommodative monetary policy, is broadly the right policy mix for the current circumstances. Of course, it's worth mentioning also the monetary policy, developments of monetary policy, which also explain some of the exchange rate developments. As you know, recently ECB has launched quantitative easing program, so clearly to stimulate the economy and also to make sure that ECB moves closer to its inflation targets, which is inflation close to but below 2%. Currently, we are in negative inflation in euro area. As I mentioned, we expect this situation to be corrected in a due time because main driver of this negative inflation is declining oil prices, and we do not expect them to decline forever. So inflation will correct itself, but it's also clear that also the core inflation, if we correct for energy prices and unprocessed food prices, is maybe around 0.7, 0.8%, which is also substantially below ECB target. So ECB is now doing this quantitative easing. It's certainly providing another stimulus to the EU economy. But it's important that EU member states use this time wisely, because only with monetary policy means it's not possible to solve the structural problems of the economy. So you still need to do the necessary structural adjustments which are needed, and ECB is basically now buying time for EU member states to do this necessary structural adjustment. And it's also, I'll probably stop with this. This crisis also revealed certain shortcomings in a institutional architecture of the EU, and especially of economic and monetary union, or Eurozone. And a number of steps had been done during the crisis actually to correct these institutional shortcomings. I will just mention some. First, the fiscal and macroeconomic governance framework has been substantially strengthened by introduction of so-called European semester, where European Commission is taking much closer surveillance of EU member states, both budgetary and macroeconomic policies, and has a possibility to intervene and even in extreme cases launch sanctions against member states which are not following the common rules. Second important element is also providing for some kind of financial backstops for financial sector and also for EU member states, especially euro area member states, something which was absent before the crisis. So we know some temporary instrument has been created, European Financial Stability Fund, and now it is being replaced by permanent financial backstop, European Stability Mechanism. So there is some fallback in a case member states run into difficulties, as it was the case with a number of member states during the crisis. Third, it was also clear, as in US, that there is a need to strengthen financial sector supervision, and in EU, additional problem of the supervision was that it was also very fragmented, relying basically on 28 national supervisors. In what has been done, basically, so-called banking union has been created, which on one hand provided single rule book how to actually deal with financial sector, but also now created single supervisory mechanism, and now we're also creating single resolution mechanism and using bail-in as a main principle instead of bail-out by the taxpayer. So also banking sector's supervision has been substantially strengthened and centralized. And now I'm being indicated that I am already over my time, so I'll probably stop here. In any case, just to reiterate once again that now in Europe we are seeing European economy gradually recovering. We are seeing that this recovery is actually strengthening, and we believe we have a right policy mix with boosting investment, with renewed focus on structural reforms, and with still fiscally responsible policies actually to facilitate this recovery. Thank you very much.
Well, thank you very much, Mr. Vice President. I'm Andrea Montanino. I'm the Director of the Global Business Economics Program at the Atlantic Council. And let me say, I was at the European Commission working in 2003, 2004, 2005, when enlargement took place. And it's really exciting for me having a Vice President of the European Commission that comes from one of those countries, which is Latvia. I'd like to pose at least three questions to you, one on the past, one on the present, one on the future. Let's start from the past. I mean, everybody's talking about Greece nowadays, but I think it's important to remember that Europe faced a very severe crisis a few years ago, and I talk as a European, were able, to overcome. I think we have to remember Latvia, we have to remember Portugal, we have to remember Ireland, we have to remember Spain. So all countries that passed through a severe crisis and they came out. So my first question to you is, according to you, which are the strengths of Europe that allow to move on and to basically survive to such very difficult situations?
Certainly Europe was going through a very severe crisis, and unlike US, where one can say that you only had a financial sector crisis and burst of the housing bubble, in Europe we additionally had also sovereign debt crisis. Member states, EU member states being cut off the financial markets, being not able to finance their budget deficits from the markets. So which was making the situation substantially more complicated, and also was of course making necessity for having a different set of fiscal policy. So in many cases in Europe we were not able to do fiscal stimulus because markets were just not permitting for that. But then what was helping the Europe actually to deal with the situation? I think what was helping was really ability to adapt quite quickly to this new situation and to introduce necessary changes in our institutional designs. Of course, it's still EU member states which had to do their reforms, their fiscal adjustments in order to deal with a crisis, but it's also important that Europe reacted very quickly by creating necessary solidarity mechanisms, financial backstops. I already mentioned European Fund, European Financial Stability Fund initially, and now European Stability Mechanism, created by now also this banking union, so centralized the financial sector supervision, and so really that Europe was able to react quickly to this situation and to address this institutional shortcomings which we had. Of course, this work is not over. In a sense, we still now are looking at what next steps are needed to deepen economic and monetary union. So basically, what next are steps are needed to strengthen the euro area. And on this, already during this year, we expect some new reports and new initiatives how we will be actually strengthening our currency union.
Thank you. A question on the present now. And then, of course, I invite the audience to raise your hands if you have any question for the Vice President. The question on the present is on investment. I mean, you just said how important it is for Europe to start a new wave of investment, and the investment plan, so-called Juncker plan, is clearly the cornerstone of the whole needs and so my question is, imagine you have to convince an American investor to participate, say, in the Juncker plan, and to put their private part of the money in some infrastructure project. What would you say to such an investor? Why one should put the money and participate to this Juncker plan as a private investor? And the second question on the investment plan is, since at the end of the day it will be the market to decide which are the best projects to finance, don't you see the risk of increasing divergence in Europe rather than increased convergence? Because a risk I see that maybe projects that will be financed will be concentrated in some countries and maybe not go in those countries that there is more need.
So first on why would US investor come and participate in this Juncker investment plan. First thing I could mention is probably more general. Europe is still the world's biggest single market. There's not a single market, US or China, whatever, which is bigger than Europe. So still, I think it's a good opportunity to come to the world's biggest market of 500 million consumers. Then, of course, this Juncker investment plan provides for some additional incentives for businesses to do so. As I mentioned, also the possibilities for some first risk absorption guarantees and some other incentives why private business may find this attractive and may overcome what is now generally quite strong risk averseness, as I mentioned, both for borrowers and for lenders. So, and then I forget the second part of the question.
Well, the second part is the risk of divergence rather than convergence among member states.
So, and yes, but of course, to make sure that private investors are willing to come and are willing to invest, it's important that the management of this European Fund for Strategic Investments is professional and that projects are based on merits. And that's why we don't have country or sector quotas, which of course clearly raises this prospect. But first, I would say, generally speaking, facilitating investment will be beneficial for the whole EU. And by strengthening economic recovery in the EU, I think all EU member states will gain. And then we also have number of targeted instruments, targeted financing, which is exactly to reduce divergence, which is EU regional policy or EU structural and cohesion funds, which are exactly meant for investments in economically less developed countries in EU and less developed regions in the EU, which may be also within probably generally speaking, more economically developed countries. So we have this strong regional policy dimension, and this financing is coming in form of grants and not in form of loans. So it's really grants which those regions are receiving and able to facilitate their economic performance. In this case, it's of course loans as a main instrument, and it's merit based. So while acknowledging that of course it may raise some questions as regards of geographic proportionality, and so we still believe it's worth pursuing it this way because the idea is really to unlock private investment, and then we really need to make sure that conditions are right for actually private investors to come.
Thank you. Before I move to my future question, I'm asking whether, please.
Yeah, it's Doug Elliott from Brookings. It's Doug Elliott from Brookings. As you know, the role of Vice President is new at the European Commission, and it's frankly rather mysterious to almost everybody who's not at the Commission. Could you talk a little bit about what you actually do and how you coordinate formally and informally with the commissioners?
Mm-hmm. Okay. Yes. This European Commission's structure certainly is new, with vice presidents given a coordinating role. And the idea behind this proposal was to overcome the silo mentality of European Commission, because really if you look how European Commission works, and if you had worked in Commission I think you will find it familiar, is that each structure, each Directorate General is working on its own, and they are really not communicating with each other, which as a result often resulted in situations that different units, different DGs, Directorate Generals in European Commission were producing somewhat conflicting documents, somewhat conflicting policies. And often it had to be resolved at the very late stages when it was already creating substantial problems. So the role of vice presidents is actually to coordinate their sphere of responsibility and to have an overall picture of some policy areas, to identify possible conflicts or divergences of opinions early on, and actually to work early on that all relevant Commission structures are working in the same direction. That's basically the main role in my capacity as Vice President for Euro and Social Dialogue. Basically, one of the key tasks is to ensure stronger coordination between economic and financial policy on one hand, and social and employment policy on another hand, to make sure that both factors are properly taken into account when we are making EU's macroeconomic decision making. And then I was mentioning this EU macroeconomic governance European semester. Then if you would read my kind of mission letter, which President Juncker wrote to me, to other vice presidents, literally the first point on this mission letter is to deal with European semester. So basically to coordinate this European macroeconomic governance and to ensure a proper balance between economic and social aspects in this governance.
Please.
Thank you. Krishna Guha with Evercore Partners. I'd be interested in a little bit more discussion on the future institutional deepening of monetary union. So as you mentioned, there have been important steps taken in recent years. But I think there's also a broad consensus that the stability of the Eurozone over the medium to long run requires further institutional deepening, whether that's in fiscal or in structural and other competitiveness areas. And of course, that could be particularly important if the current developments in Greece were to end in a bad way. Now, I'm not asking you to comment on that specifically, but on the broad question of, could you give us a little bit more about your sense of what the realistic agenda is going forward in terms of institutional deepening in the Eurozone? Thank you.
Mm-hmm. Okay, yes, on deepening of economic and monetary union, indeed there is already a number of documents which had been prepared in previous years, so-called Four Presidents Report, also blueprint for a deep and genuine economic and monetary union, Commission's communication of the social dimension of EMU. So there is actually a number of documents to build on. And indeed, if you look at some of the initiatives, had already been implemented, which were discussed in those documents. I was mentioning those financial backstops, European Stability Mechanism, Banking Union, macroeconomic governance, so-called six-pack and two-pack regulations. So a number of things had already been introduced. And then there are other elements which are seen as more longer-term elements which require also some certain discussions. There are discussions on so-called fiscal capacity of euro area, which also would provide for more some automatic stabilizers. There are discussions about common bond issuance or so-called Eurobills. There are discussions about still strengthened governance framework. But I would say so now, from the Commission's point of view, we're trying to divide this process in two parts. One is what we can do in still relatively short term within existing treaty, what we also often call deepening by doing. And a second stage is already more advanced ideas or more deep changes which also require treaty change. So really we are distinguishing between those two steps, but then just to give a general consideration, I'm not expecting this going to be an easy discussion because, as you know, there is lots of demand towards more solidarity, more risk sharing, more mutualization on one hand, and then if you want more control and more sovereignty sharing on another hand. So what you will need to do, you will need actually to move on both if this process is going to be successful, because if some countries are going to accept more risk sharing, which some other countries maybe wish for, they will also then require more sovereignty sharing or more control, or to be sure that actually common rules are being followed. And so I expect quite a complicated discussion on this, but nevertheless this discussion has already started. First discussions were in a February EU Council, and already by mid-year we could expect second Four Presidents report, which would then outline possible new steps and deepening of the EMU.
Just a very quick follow-up. Could you give us some examples of the first category where meaningful changes can be taken with a treaty change?
Okay. First, it's really to complement or a couple of initiatives which already had been taken. First is on macroeconomic governance process, which we are now calling streamlining of European semester. because this European semester has been created more or less on ad hoc basis during the crisis, and now there is a good time actually to look at all those regulations, how they are matching each other, how reporting requirements can be simplified to the member states, how can it be, how this process can be done simpler and more understandable to member states and to the broader public, so that there is actually more ownership by the member states in this European semester and in corresponding recommendations which are then addressed to the member states during this European semester. Second is still to finalize the work on the banking union. There are a couple of elements which are already introduced. I mentioned single supervisory mechanism, single resolution mechanism. Now, for example, it's a building up of a single resolution fund, which is still work in progress, but which is also now gradually taken place, can be done within existing framework. So there, I would say, number of practical things which still can be done within existing treaty, with or without changing secondary legislation, and this is, so to say, the first step we are now concentrating on.
Thanks, Andrea. Thank you, Mr. Vice President. Alex Peritier with AICGS. My question is about some of the risks out there, and I would like to concentrate on two risks which are not necessarily correlated. One is Greece, and I would like your assessment on how big the potential for a deterioration of the Greek situation is, how that can affect the recovery that you just described, if at all. And the other one, which is completely separated from that, at least thanks to the developments of the past few years, is how to transmit monetary impulses to the real economy. And you mentioned capital markets union as one way to do it, but of course we all have to assume that capital markets union is more of a mid to long-term project than immediate goal. And therefore the question is how to restore some confidence in the banking sector that still has a high degree of non-performing loans, and there are some movements in some of the member countries to park these non-performing loans into some so-called bad banks, and how that can affect the way the Commission looks on possible problems with state aid, or whether there's a way to overcome certain hurdles on your part and make that possible. Sorry for the two not connected questions, but I'm just trying to sort of focus on two risks. Thank you.
Okay, thank you. So first on the situation on Greece. So where we stand right now, as you know, the current Greek bailout program has been extended till end of June, and there was agreement by Euro area finance ministers to have a technical discussions with Greece till end of April, and then to take stock what is the progress, whether there is enough progress to successfully complete the existing program and to disburse the funds within existing program. So so far, one must say that progress in those technical negotiations has been limited. So more work needs to be done, and really for this program to be successfully completed, all sides must stick with their commitments, including Greece. They must stick with their commitments which they had taken within the program. But from European Commission side, that's the direction of work which we are really working to make sure that we are able to successfully complete this program. Then another question is what happens after end of June. and also Eurozone finance ministers have also, when extending the program, also outlines that this is also bridging time to discuss the possible follow-up arrangements with Greece. But this means that, of course, there has to be good progress in closing the current program before there can be meaningful negotiations on the follow-up arrangements. Well, fundamentally, I would say the situation is, if you want to say, manageable, because if you look at Greece, Greece was actually returning to the economic growth already in the second half of last year. Greece was decreasing unemployment, having a good job creation rate. Greece was delivering on its fiscal targets, was about to finish its bailout program, and with the help of some precautionary arrangement, was about to return to the financial markets. So I would say fundamentally it's all still there. So it's really the question more whether the new Greek government is taking up their responsibilities and actually delivering on this, because those fundamentals are now allowing for Greek economy actually to recover, and we actually were seeing this already late last year, that the Greek economy was starting to recover. So that's what I can say at this stage from the Commission's point of view. So we are working really and hoping to have a successful program conclusion. Then on second questions, how monetary impulses are translating into a real economy. Well, and issues with the banking sector. Well, certainly there are some elements which we are seeing, that first, liquidity is really easily accessible in the EU, but still it's not always translating also in a good credit conditions for the real economy, because banking sector now is strongly risk averse, and also there are still a process of deleveraging taking place objectively, so you do not expect major credit growth during the deleveraging. And also there are still problems with non-performing loans, even though the stress tests and asset quality reviews, which we had been carrying in a banking sector during the last year or a bit more, actually showed that fundamentally also the banking sector is sufficiently capitalized with sufficient liquidity and able to deal with its current problems. Of course, the situation is once again not even and not equal in all member states, and there are some initiatives in some member states as regards dealing with non-performing loans, creating some bad banks. One can note, for example, Italy, which is showing initiative in this, but there are also similar ideas, considerations also in some other member states. And from the Commission point of view, we are working closely with Italian government and trying to find this solution, which really allows for dealing with non-performing loans program in the banking sector while respecting EU's state aid and bank resolution rules, because now also one issue is the state aid rules, another within the banking union there is this bank resolution recovery directive, or how it's properly called, which is then also to be respected from, so to say, financial sector supervision point of view.
Mr. Vice President, thank you very much. Time is running, so I will keep my question on the future for the next time you come. I want to thank you, all of you, for being here today, and of course, a huge thank to you, Mr. Vice President, for joining us this morning. Thank you very much.
Thank you. Thank you.